Welcome to Looking at the Markets with me, David Modell. Today's video is going to be kind of basic, but it's also a good review for anybody who likes to short sell stocks or ETFs, commodities, currencies, whatever. This might just get you thinking about an alternative to short selling. All right, so no matter what level you're at, you could certainly benefit from this. And if you're a beginner or intermediate, this will definitely benefit you. So today's topic is forget about short selling stocks. Forget it. Here's a better way. All right, well, let's say you think that the market is going to go down, or maybe a particular stock or ETF or commodity, currency, whatever. You think it's going to go down in the future. And you can make money from that. Okay, most retail traders just think about buying low and then selling later on when the price goes up. But you can be like this guy with his evil grin. All right, he's happy because the market's going down. He's excited because he's making money, and that can be you. All right, most people just go long. You know, they buy a stock or whatever when they think the price is low, and then they hope and wait for the price to go up, and then they sell at a higher price and they make a profit. But there are people who do short selling. They actually sell first. They sell before they buy. It's kind of backwards. They sell because they think the price of something is too high. They think it's going to go down in the future. And then if the price does go down, then they can buy back the stock or whatever that they sold short. They can buy it back at a lower price. Remember, they already sold it, so they can buy it back at a lower price for a profit. Of course, it can go the other way around. The price can go up, and then they have to buy back at a higher price than they sold short for, and that would be a loss. So again, a lot of this is a review, but I'll make it quick. So short selling works this way. Basically, you're the investor and you don't own the stock, but you want to sell it to somebody because you think the price is going to go down. It doesn't have to be a stock. When I say stock, it could be an ETF, could be a commodity, currency, whatever. So, but I'll just say stock from now on to make it simpler. So the investor borrows shares of stock from the broker, from the brokerage. Okay, so the broker lends the shares to the investor, and that's you if you're short selling, and then you sell it to somebody on the open market. All right, and then hopefully the price goes down. Hopefully. Now remember, you don't own those shares of stock. You just borrowed them from the broker, and the broker is going to want those shares back. You don't get to keep them forever. So at some point, you're going to have to buy back those shares of stock, hopefully at a lower price. But if the price went up, then you might have to buy back the stock at a higher price. Okay, but let's say the market or the stock does go down. Great, then you can buy those shares from the open market at a lower price than you sold them for. So you made a profit. Okay, and then you return those shares of stock to the broker. And that's how you make a profit if you're short selling. But here's the thing about short selling. Okay, let's say the price is here when you make the short sale, you initiate it, all right? Your profit potential it can be pretty big. You can make a lot of money if the price of the stock goes down and down and down. But remember, the price of the stock, the price of any stock can only go down to zero. It can't go any lower than that. And so your profit potential is limited. Again, it could be a lot of money, but it's limited. It's not unlimited. Now, what about your loss potential? What if you short sell the stock and the price of the stock just keeps going up and up and up and up and up? Well, there's no limit to the amount of money you can lose. Remember, the price of the stock can go down to zero, but not below zero. But there is no ceiling. I mean, it could, at least mathematically or theoretically, the price of a stock can just keep going up and up and up to infinity. I mean, there's no highest price on a stock. So your maximum loss, your potential losses are unlimited. In fact, you can even Not only could you lose all of the money in your trading account, you can even lose more than that, and then you'll end up owing money to the broker, and that's pretty bad. Losing all of your money and owing some money, that's probably not a position you want to be in. And if this sounds impossible, I mean, there are penny stocks, micro cap stocks, small cap stocks that can, after you make a short sale, those small cap stocks can jump up in price very quickly. They can double, triple, quadruple, or even more in price. And now you're in deep trouble financially if that happens. Okay, here's another way of looking at it. Short selling, again, the share price goes down after you make the short sale. You can, as it goes down, you make more money, and you can make a lot, but there's a limit because the stock's price can only go down so much. Whereas as the share price goes up and up and up, your potential losses are unlimited. So let's look at an alternative. How about buying put options instead? Yeah, instead of borrowing shares of that stock or whatever from your broker, and you have to have generally speaking, you have to be approved for short selling, and you probably have to have a margin. You have to be approved for a margin account, and so you're borrowing money or borrowing shares, I should say. Here's an idea, and you don't really need necessarily a margin account for this, and you don't have to be approved for short selling for this strategy, this alternative. You do have to be approved for buying put options, but I don't think it's that difficult to be approved for buying put options. Okay. I mean, that's between you and your broker. But if you shop around for brokers, there are some very option-friendly brokers out there that are likely to approve you for that. So you may want to, depending on your situation, of course. So, you could shop around for that for different brokers. But, you don't have to borrow shares. You buy one or more put option contracts. And what's great about this is that your potential profit, again, it's limited just like it is with the short selling, because the price of the underlying equity, the stock, ETF, whatever, can only go down to zero. But what about the losses? They're capped. There's a maximum loss. The most you can lose when you buy put options is whatever you paid for those put options. So for example, if you bought $500 worth of put options or puts, the most you can lose on that trade is $500. You cannot lose more than that. So notice that the share price, the price of the stock goes up and up and up. It keeps going up and up and up, but your maximum loss doesn't keep getting bigger and bigger. It stops at whatever you paid for the put options, unlike with a short sale where your potential loss, your max loss, is unlimited. And whenever I make a trade of any sort, I like to know, in fact, I need to know what my max loss is going to be. I don't make a trade if I don't know how much I could possibly lose. Too many traders, especially beginning and intermediate traders, are only thinking of how much money can I make? How much, right? But you really should spend as much time, or really more time, thinking about what's the most I can lose. Is it unlimited? That's probably not the way to go. There are exceptions, but that's oftentimes not the way to go. As opposed to buying put options where you know what your max loss is. And there are horror stories out there, scary horror stories. Okay, this is from MarketWatch. I remember this happened, I think it was about a year ago, something like that. This guy, this trader, retail trader, short sold. It made a short sale on KBIO. That's the ticker, which is a Calabios. And because he saw that the price was trading within a range, I guess, and it's kind of going higher, higher, higher. And this is a low priced stock. This is not like Apple or some Priceline or some high priced stock. This is one of the lower priced stocks, and those lower priced stocks, especially if they're smaller companies, have the potential to either go way, way down in price very quickly or way, way up in price very quickly. They can really jump up or down in price in a very short period of time. So this gentleman, somewhere, somewhere around here, short sold, sold short KBIO, and for some news related event, for some reason, bam, the share price just rocketed up so quickly, so fast that you don't even really have time to react, not much time. Okay, it just shoots right up. And this gentleman lost, well, you can see right there, over $100,000. And if I recall correctly, he ended up owing, I believe it was E-Trade. You might want to double check the news item on that. I believe he ended up owing E-Trade $11,000 or something like that. Some large amount of money. Again, that my exact details on that might not be accurate. You might want to check the news article on that. But if I recall correctly, he ended up not only losing his, what's in his account, but he ended up owing money to the brokerage, and that's miserable. So, you want to think twice about short selling, especially if it's a stock that's prone to large price movements. And you may not, this didn't look like it was prone to large price movements, but yeah, anything can happen in these markets. You never know. So what's the takeaway of all this? Well, while short selling stocks is one way to profit from a stock or ETF that you think is going to go down, consider buying put options. Now, you do this in small amounts. Okay, please only buy put options. Only buy in small amounts that you can afford to lose. Okay, I don't want you buying large amounts of put options. Please don't do that. Okay, small position sizes. But consider buying put options as a safer alternative with a limited maximum loss. And that's what I like about put options so much. All right, so if you want some more help with this, you can contact me anytime. My name is David Modell, and my email address is davidmodell@gmail.com. Thanks a lot. I'm here to help you. And by the way, if you like this video, feel free to give it a thumbs up, put a comment in there. I'm really glad to hear from everybody. So go ahead and leave a comment. Thanks a lot.